Welcome back, everyone. We're taking a deep dive today into stock return predictors. Those variables that, might give us a hint about how a stock will do. You gave me some fascinating research for this, especially that paper by Jonas Frey, which stock return predictors reflect mispricing. I think we should unpack what that even means and, why it should matter to anyone listening, and also how analyst predictions play into all of this.
It's a really interesting area of finance, For a long time, we thought stock returns were, well, mostly driven by risk. The higher the risk, the higher the return.
Right, makes sense.
But Frey's research is pointing to something else, something that may be even more important, and that's mispricing.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so before we go too far, can we define mispricing for our listeners?
Absolutely. Mispricing is basically when a stock's price doesn't actually match its true value.
Oh, okay.
So it could be overvalued, like think about a popular tech stock that everyone's really hyped about, or it could be undervalued, like a hidden gem that the market just hasn't noticed yet.
Okay, that makes sense.
Think of it like this. If a company is expected to pay out big dividends in the future, but the stock price is way lower than what those expected dividends would, justify, then it's probably mispriced.
So, okay, to use a food analogy, it's like finding a gourmet meal at a fast food price.
Exactly.
Okay, so there's a disconnect between the price and the value.
Mm-hmm.
So back to stock return predictors. You mentioned that traditionally the focus has been on risk. But what Frey is suggesting is that these predictors might actually be showing mispricing, right?
Exactly. And he uses analysts' forecasts to test this whole idea.
Okay.
So analysts, they're always making predictions about company earnings, which obviously affects stock prices.
Yeah.
And Frey's insight, the key here, is that if a return predictor can also predict changes in those analyst forecasts, then, well, that means the market isn't being perfectly rational.
So it's not just about the hard numbers. It's about the human element, like, the analysts, the investors, all of us bringing our own hopes and biases into the mix.
Exactly. And what's so fascinating is that Frey actually tested a huge number of these predictors, 172 to be exact. And he found that at least 40% of them are linked to mispricing. That's a huge chunk of the market that might be behaving, well, not entirely rationally.
Okay, now that is really intriguing. So it sounds like we're kind of moving away from finance and more toward behavioral economics. Could you give us a specific example of a predictor that Frey found to be tied to mispricing?
Yeah, so one that's really interesting is momentum. Have you heard about this? The idea that stocks that are performing well tend to just keep going up. And vice versa. That's momentum in a nutshell.
Yeah.
And Frey found that this momentum effect is actually really influenced by mispricing.
So buying a stock because it's been, on a hot streak might not be the smartest move. We could be falling for some kind of market illusion.
It's definitely worth considering, yeah. Another one of his key findings is that even, well-established factors like profitability and investment, even those show signs of mispricing. And these are cornerstones of models like, the famous FAMA French five-factor model, which is used by tons of investors to evaluate risk and returns.
Wait, so you're saying that even these super well-established factors could be flawed because they are incorporating mispricing?
That's what Frey's research suggests, yeah. And it gets even more interesting, I guess you could say, when you start to think about how mispricing actually can show up in two different ways: resolution and buildup.
Okay, I think this is where we might lose some listeners.
Mm-hmm.
What's the difference between these two types of mispricing?
Sure. So resolution mispricing is when the mispricing just kind of gradually corrects itself, over time. So think of it like a bubble that's slowly deflating.
Okay.
But build-up mispricing, now that's where things get really interesting, because the mispricing actually gets worse before it finally, snaps back to reality.
So it's like watching a car slowly veer off the road.
Yeah.
It's going to crash eventually, but it just keeps going further and further off course. So in Frey's findings, what did he see about these two types of mispricing?
Well, he found that, resolution mispricing is definitely more common, but build-up mispricing still represents a pretty big chunk of the mispricings he identified. It was around 43%, actually. So that means in a lot of cases, those irrational exuberances can really stick around for a while.
That's amazing. This is really challenging, like my assumptions about how the market works.
It is like peeking behind the curtain a little, isn't it?
Yeah.
And that's what makes this so compelling, right? We're starting to see the market not just as this collection of, numbers and algorithms, but as a reflection of human psychology with all its, quirks and biases.
Yeah, it's fascinating.
Yeah, it's like we're lifting up the hood on the market and seeing the messy human engine that drives it all.
It's messy, but interesting, for sure. But I have to ask, if mispricing is so common and it's tied to things like momentum and profitability, doesn't that make it basically impossible for the average investor to actually make good decisions?
Well, that's the question, isn't it? But remember, what Frey is doing here is really all about identifying these patterns of mispricing that are, well, predictable. So it's not just, random noise. There's a method to all this madness.
So if we can understand these patterns, could we use that to our advantage?
Frey's work definitely suggests that there could be opportunities to profit from mispricing.
Okay, so let's say we're looking at a stock and it's showing signs of mispricing based on one of these predictors. What would be the next step? How do we know if we should buy or sell?
Well, that's what the difference between resolution and buildup mispricing is super important. So if it looks like the mispricing is going to resolve itself over time, you might want to short the stock, bet that the price will go down. But if it looks like it's going to build up, then you might want to go long, hoping to, ride that wave up before it all comes crashing down.
Okay, so I'm seeing the logic here, but how do we determine whether a mispricing will, resolve or build up? That seems like the real secret sauce here.
Yeah, and it is tricky, but Frey actually gives us some clues. He uses those analyst forecasts we talked about to sort of gauge the direction of the mispricing.
Okay, so if analysts are consistently overly optimistic about a company that's mispriced, that would point to a build-up situation. And if they're overly pessimistic, that might point to resolution. Is that right?
Exactly. By comparing, analyst forecast from when the mispricing is first identified with the earnings that the company actually reports later on, we can get a sense of whether that mispricing is going to get, bigger or smaller over time.
So it's like we're using analysts as a barometer for overall market sentiment.
Yeah, in a way. And what's interesting is that Frey's research shows us that both types of mispricing are pretty common in the market. It's not just, going in one direction.
So there's no magic formula, no foolproof method for exploiting mispricing, right?
Right.
It's more about understanding the nuances of each stock and using those analyst forecasts to kind of guide us.
Exactly. It's about combining, the quantitative analysis with an understanding of human behavior, market psychology.
Yeah. Probably not something to try at home without, doing a lot more research. So speaking of research, where does Frey think investors should be focusing their attention? If they are looking for these mispricing opportunities, are there any specific sectors or types of stocks that stand out?
Well, what he found suggests that, certain categories of predictors are more likely to show mispricing than others. So those momentum predictors we talked about before, those are often a good place to start.
So a hot stock that everyone is chasing could actually be a good example of mispricing.
It's possible. But of course, it's important to remember that not every stock that has, momentum is mispriced. But it is a red flag that, needs a closer look.
Okay, so momentum is one area. What about the other factors like profitability and investment? Where do those fit in?
Well, even though those are usually seen as pretty reliable signs of a company's financial health, Frey's research says that they can be influenced by mispricing too.
Okay.
So for example, a company might be reporting high profits, but they're actually, doing it at the expense of long-term growth, or they might be using, some kind of tricky accounting to inflate their earnings.
So we have to look beyond the surface, beyond the headlines, beyond the hype, and really dig into the fundamentals.
Yeah, and don't forget the psychological factors too. Is the market overly optimistic about a company's future? Are the analysts making, crazy predictions? Those are all important things to think about when you're trying to gauge that potential for mispricing.
This is all making sense. But I think we should really emphasize that this is not, some get-rich-quick scheme. This is really about gaining a deeper understanding of the market and, honing our skills and being patient.
Absolutely. It's a journey, not a destination. And one that, honestly, never really ends. The market is always changing, always giving us new challenges and new opportunities. But by, embracing this idea of always learning and always thinking critically, we can improve our chances of navigating those waters, successfully.
Well said. I have to say, this has really changed how I think about the stock market. It's not just about, the numbers and the risk. It's about, there's this whole human side to it, all this psychology and bias. We can't ignore it.
It's like realizing the market isn't this perfect rational machine, right?
Yeah.
There's emotion in there, speculation, even a bit of, what do they call it, herd mentality woven into how prices move.
Yeah, exactly. And that brings us back to one of the big ideas in finance, the efficient market hypothesis. The idea that stock prices basically have all the available information baked in already.
Right.
Which would mean it's impossible to, consistently beat the market. But if mispricing is as common as Frey says, and it's all driven by, predictable human biases, doesn't that just, throw a wrench into the whole efficient market thing?
It definitely complicates things. The efficient market hypothesis, it all hinges on the idea that investors are rational.
Right.
And that prices adapt quickly to new information. But what Frey's showing us is that, well, that's not always how it works. If mispricing can stick around and even grow over time, that means there are opportunities for investors who can, spot those inefficiencies.
So maybe the efficient market hypothesis isn't totally wrong. It's just not the whole picture. It might be pockets of inefficiency, areas where human behavior kind of creates these distortions that we can take advantage of.
That's a good way to put it, yeah. It's not about getting rid of the whole theory. It's about recognizing that it has limits. And that's where, Frey's research is so valuable. By understanding these patterns of mispricing, we can maybe make smarter decisions, even if we can't, predict the market perfectly.
I think that's important for our listeners to remember. We're not saying you can just become a stock market genius overnight just by reading this paper. It's really complicated stuff.
Yeah.
And there are no guarantees.
Absolutely. Investing always has risk. But what Frey's work does is it gives us a framework for thinking about risk in a more complex way, I guess you could say. So it's not just about how much a stock price might go up and down. It's about the potential for mispricing, those gaps between price and value, which can, create opportunities, but also pitfalls. The market is always changing. So we have to keep, updating what we know and refining our strategies and staying open to new ideas. Frey's research is just one piece of the puzzle, but it's an important one.
It definitely has given us a lot to think about. So as we wrap up this deep dive, is there one key takeaway you want our listeners to remember?
Don't underestimate how powerful human behavior is in the market. It's not all about numbers and algorithms. There's psychology, emotions, and some, irrationality. By recognizing that, I think, we can start to see the market in a new light, one that's both more complex and more interesting, maybe.
Well said. This has been a really insightful conversation. Thanks for joining us for this deep dive into stock return predictors and mispricing.
And remember, keep exploring, keep asking questions, never stop learning. The market is full of surprises, and that's what makes it so exciting.
We'll see you next time.